All right, welcome back. My name is Chris Sachinelli, and I get to build, buy, and sell simple, profitable businesses every single day. And today we are going to be talking about probably one of my personal passions, my hobby, where I nerd out all the time and spend a ton of time to try to get as best as I possibly can. It is what juices me, it is what fills my tank. We are talking about deal structures, right? How do you structure better deals? So when it gets into the build, buy, and sell game, especially specifically on the buy side, but also on the sell side, because you need to know it for both, right? It's when you're in a conversation, you've gone through some initial, preliminary due diligence, you've entered into an LOI, and you're getting into a conversation to now actually start to talk about structuring a deal. How do you approach it? Right. So today's video, we're going to get the foundational information. This is a 20,000 foot video. We're not going to go into devils in the details of like how we position to negotiate on each side of each one of the deal structures and the ways in which we can. And we're also just going to cover kind of like the heavy hitters as well. So this is a foundational video for sure. But if it's something that you're interested in, I definitely am. And I'm always more than happy to have an in-depth conversation on any of these structures, or if it's a deal that you're working on, how we could potentially better help you navigate it there, perhaps through our business brokerage, Simple Business Broker as well. We do this, on behalf of other folks. So let's get into the video. Before we do, our legal, they're starting to put a little bit of cuffs on me as we're picking up the content and the strategy and we're putting more out there. So quick disclaimer, this is all for educational purposes. Everything inside of this video is for educational purposes, does not constitute legal or financial professional advice. And, please always consult with a licensed professional before making any decisions based on the information provided in this video, right? So asterisk, asterisk, asterisk. Now let's jump on into it, right? So the first type of deal that you can get done in terms of a structure is super simple, right? So we're all about keep it simple, right? Simple profits, simple business brokerage. Everything we do is simple, right? With Bootstrap Capital, we all are about simple, profitable businesses, right? We build, buy, and sell every single day. The simplest possible deal that you could ever get done is an all cash deal, right? That's just, you have the money in the bank, right? The money is there. You want something, you go buy it, right? That's the simplest thing in life. You can also get cash from a financing partner, right? So we provide acquisition capital with Bootstrapper Capital. So if you want to acquire a business, we will help you underwrite the deal, and then we'll help you, get the capital that you need to be able to acquire it. We also help you structure deals, and we provide all of these services again through our business brokerage as well. If you're in the buy or sell process from more of an advisory and agent perspective, right? But the simplest way to go out and buy a business is to just get cash, right? On an advantage side, obviously it's a quicker transaction, right? Like if you want something, you buy it. If you got the cash, you get it type of thing. Not to say that you're not going to complete the entire deal process, right? So this is not a easy button where you now, skip over things like diligence or negotiation of the terms of the deal in terms of covenants of the deal or anything's exclusions and things of that nature, right? So it's still a full deal. You're just the financing aspect, and the likelihood of a deal falling apart because of more complicated financing or not being able to get to terms is less complicated, right? So the ability to get to a close is higher, right, and easier. On the bad side, it's all cash, right? So it's kind of, if you don't have the money in the bank, right? Say you don't have a couple $100,000 or a couple $1,000,000 sitting around, right? Because we do micro deals, right? Say you don't have the money on hand, you got to go get the money. And if you don't have, room for the money, if you don't have the ability to get the money, like that could be difficult, right? So getting to the financing could be difficult. And you also lose out on some of the other perks of some of the other structures that we're going to go through as well. So you may be leaving things on the table, especially if you're a buyer, right? A really simple example for this is, I got $5,000 in my bank and Sally Sue down the street has a lemonade stand. And I like that lemonade stand. I think she did a great job with branding. I think she's got a perfect corner spot and she's got a great concoction of a mixture and some proprietary IP behind how she makes that lemonade. I just go up to Sally Sue and say, hey, Sally Sue, here's $5,000. This is now mine. And like, that's the simplest possible over exaggeration of an example, but that's a great example of just like what a simple cash purchase is. Now, unless you're an experienced buyer, the asterisk here that I would put is that you would avoid a cash purchase. Now, if you're going out and you're getting financing, you can also have the advantage of leaning on your lender, right, to help you diligence and underwrite a deal, because they need to mitigate their loss ratio risk, right? So they want to make sure that it's a good buy. So you can, leverage that. Say you don't have all of the cash, or say you can't get financing. What do? Do you just walk away from the deal? No, you don't have to. There's this thing called seller financing. And seller financing is a great way to buy a business if you're new to the game. It's also a great way to buy a business if you've done it 100 times, right? So, seller financing is a really clean structure. And realistically, what it means is the seller is really becoming like the bank, right? They're pretty much becoming the lender to you. So they own a business. They know what the business is. So Sally Sue, let's go back to our lemonade stand example. Sally Sue owns Sally Sue's Lemonade. She owns all of it outright. And she owns the business. She wants to sell the business to you. You do not have the $5,000. What she will say is, hey, I'll give you this business today. You'll take possession of this business today. You will be the operator of this business today, and then you will pay me over time, right? And the payment's going to be coming out of the hopefully operational profit of that business. Now, that being said, if there's no profit, you could still be left on the line in terms of coming up with the payment for that note. And the interest rates, may ultimately be a little bit higher, right? So from an advantage side, it's easier to get to a deal if the seller's willing to do a deal this way, right? Because there's only two parties in the transaction. You're cutting out the third party from the financing side, right? Keep it simple. You can potentially negotiate because maybe it's a motivated seller, or maybe it's a motivated buyer, right? So maybe there's wiggle room in terms of like figuring out better angles to the deal where somebody's willing to slide a little bit to make the deal a little bit better so that everybody can get to a close faster, right? And it's a truly aligned interest deal, right? So like by interest, I don't mean interest payment. I mean like interest, like alignment of the why, right? Everybody wants this deal to work. Everybody wants the business to continue to work because, the seller is getting paid back over time from the success of the business. And the buyer needs the business to work to be able to pay the seller. So there's good alignment. Now, the disadvantages are, because the seller's bearing a lot of risk in this situation, you really, 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 really want to negotiate the terms of the deal, right? So there's going to be definitely covenants into this type of deal that will help mitigate the risk inside of the deal. Like a simple example could be, and I don't know if I want to get to examples on this video because we're going to do other videos on this, but I will. Simple example could be like a clawback. So say somebody, misses, say the buyer misses a payment, right? Or 2 payments in a row or 3 payments in a row or whatever the case may be. There could be a clawback where it's a reversion of ownership, right? And the seller reclaims ownership of the business because of that, right? Simple way to mitigate risk. The job here, the hard job here, the job to be done in a sense, is to just negotiate terms that make sense for everybody and mitigate the risk into the deal. And whoever's more motivated typically gives up on the terms in order to get the deal done. But it's an easy way to close deals through that. I like seller financing. I like seller financing mixed with really nice, clean terms that help mitigate the risk for everybody. It's a great way to buy a business, especially if you're going to be the operator of that business or you have a good operator that you want to put in place and you just want to kind of gobble up deals. You could always be closing this way. I already went through the example in this situation with Sally Sue's Lemonade. So let's get into another structure. And this is a structured earnout. And this is going to be something that typically can be leveraged by the buy side to reduce risk into a deal. It could also be leveraged by the sell side to reduce the upfront cost in order to push a transaction through faster, make the deal look a little bit more appealing. And it also, for both parties, realigns interest. So structured earnout is pretty cool. So it's realistically where the seller, right, Sally's Lemonade, instead of getting paid all 5,000 up front, or instead of her seller financing all 5,000 up front, right? So either way, she was getting that 5K. The deal structure would be 2,500 to close, right? So she's going to get 2,500 through either, financed or seller financing, and then another 2,500 on the backside based off the performance of the business, right? Or potentially more, or potentially, maybe 3K on the backside based off the performance of the business, and 2,500 depending on other performance of the business. So it's a great way for there to be a performance-based clause into the acquisition. And it's a great way for a percentage of the purchase price of that acquisition to get paid on the backside and not on the front side, right? So structured earnouts are great. Structured earnouts are great in a business where it's like an agency model where you're buying somebody's book of business, right? And because you're buying their book of business, there's a lot of risk associated with that potential deal, right? There's maybe loyalty that's built up by the client base. And then once that owner is no longer the operator, the loyalty of the client base goes away and there's churn into the book. So it's a great way to also mitigate the risk of like a downgrade in the value of the business on the backside for the buy side. So it's a way for you to potentially, again, mitigate risk. And it's also a great way for the sell side, the seller, to potentially, again, participate in more market potential if they believe in the business and there's another reason why they're getting out of it and they think you're going to be a great operator. Maybe they'd be willing to take less up front in order to get more from the backside performance of the deal. So it's also a great potential alignment tool for extraction of value from the sell side. So this could be a great structure for you to back into. I love doing deals, seller financing with an earnout. Like a seller financing earnout deal is like a great deal to be done for sure. They're more complicated in terms of negotiations because, again, the disadvantage is it's more complex than just here's cash, right? Here's cash. It's simple, right? Money talks, right? Everything else walks. But when you're doing these types of deals, you got to be creative, and then you have to be very detailed, right? So you really want to make sure you're checking all the boxes and you're mitigating as much risk as possible. It's really, really, really important to be diligent into the deal when you're doing creative financing, right? So an example of this deal would be Sally Sue. She's selling her lemonade stand for 5K. You don't have all 5K today. You negotiate down to 2,500 to close. And then if you keep onto the same revenue targets, she's going to get paid back the 5K. And if you exceed the revenue targets, she'll get 3K or 4K or an additional 5K on the backside. Like that's a simple example to be able to motivate both sides to be able to get the deal done, right? Seller needs to be motivated with more on the backside, and the buyer is motivated because they have the restriction of capital. They want to close and take over faster, right? Different types of deals to be done, right? So you have, those are structures that we just went through. Those are ways to structure deals. You can cash structure the close. You could seller finance the close. You could structure earn out the close, right? Those are all deal structurings. And then you have different types of deals that are getting done. So you got an equity deal, which an equity deal is what it sounds like. You're coming in and you're buying equity into a business. This is typically when it's not going to be a total buyout, right? Many times this is very popular in private equity because it helps mitigate risk into a deal for a number of reasons. It helps keep skin in the game of the seller, and it helps position the seller for like that double bite of the apple that's so popular in private equity. And it helps with the deal structuring on the backside, right? Typically, I mean, if you're doing the creative financing deals, it's typically really more of an equity deal. But again, right, simple deals, in the lower market are usually simple and not equity deals, right? So a more complicated deal is probably going to be in this structure, right? So you're acquiring a portion of the ownership in exchange for a part of the purchase price, right? In this situation, it's like really everybody's kind of aligning into the upside of the deal. Everybody believes that this company is going to be worth more into the future. From a disadvantage perspective, it's, you're not taking full control of the company and the seller, right? So on the buy side, you don't have you could maybe have full ownership control depending on how much equity you buy. But there's a dilution of ownership, right? Either the sell side's diluting all the way down, or because the sell side is retaining ownership, there's a dilution of ownership on the buy side, right? So meaning like you're splitting the pie, right, in this type of deal, which is okay, right? That's not a bad thing. That could be a good thing, especially if you're splitting the pie to align into an upside. However, if that upside doesn't materialize, right, and you're just seeing a downside into the deal, meaning the deal doesn't really mature into like the financial forecast or projections that were originally underwritten, then you got some risk, right? And that's where the risk is going to live in this situation. So simple example, Sally Sue, right? She's down the street with her lemonade stand. And I'm like, man, Sally Sue's doing really, really great. I want to partner with her. I want to buy a portion, right? I want to buy 51% of Sally Sue's lemonade. So I'm the majority owner. I can make the key decisions. However, I want to keep Sally Sue on as an operator. She's an amazing operator. And in fact, I think she's so good that we could productize her lemonade stand. And I think we could create a teach, train, equipped system, right? Business system that allows us to find another Sally Sue and set up another lemonade stand 3 streets over, right? And now we could double the size of the business. And because of those reasons, I see all of this market opportunity. And Sally Sue, she's been grinding away, 9 to 5 for the past 5 years. And even though she's 5 years old, right? She started really young. And and she likes that idea. She likes the idea of growing the business. She likes the idea of potentially putting in operators into the day-to-day operations. And she wants to focus on, running a more mature business. And she just needs the capital and resources to be able to do that and achieve that. So there's a deal to be done. So in that type of situation, we would come in as an equity partner into Sally Sue's Lemonade. We try to drive majority ownership so that we can help mitigate the risk into the key decisions being made. And then Sally Sue gets to be a part of the ride as we double the size of this business and double the valuation over the long term. She has more resources and we can do more and build bigger business. And she has a smaller slice of the pie. She took some money off the table. So she got a little bit of liquidity, but she is now a smaller part of a much bigger pie. And in the end, she could potentially end up with way more pizza to eat, right? Next type of deal is the deal that we typically look to do from our side. And I'll fast forward videotape. End of this last slide here, I'm going to go through the difference between all of these deal structures and then why we do different types of deals and the pros and cons versus each. So the next type of deal is an asset-based deal. Asset-based deal is like, we don't want to just take a portion of the business, right? Like an equity deal. Asset-based deal is we want to buy the business. We want to buy the company. We want to acquire this thing outright, right? However, we don't want to acquire the stock, right? We just want to look at the assets of the business and we want to strip down the assets of the business. What we think the business, if we looked at the business and we looked at just the value of all of the things inside of the entity without the entity itself, that's what we want to purchase, right? So in that situation, the benefits, the advantages of an asset-based sale is you're only buying the selective things that you want, the assets, and you're stripping out the liabilities, or you're keeping the liabilities with the entity where the liabilities live. So as a purchaser, as a buyer, you're only buying what's valuable to you. And you don't have to carry the obligations, right, that the seller already has. That's really important. And I'll get back to that in a little bit. On the disadvantages, like on the sell side, the seller's typically looking to just, get the deal done and sell everything, right? Assets and liabilities, like just the stock, right? So it could make the negotiations of getting a deal done a little bit more complicated. You're itemizing all these assets. You're putting a value to all these assets, a little bit more complex in terms of a deal. We'll get into that in a little bit. as opposed to the other type of deal that you could do, right? If you want to buy an entire company, right? If you want to buy everything, which is a stock deal, right? A stock deal is quite literally what it sounds like. You're coming in and you're just buying all of the stock of the existing business, the existing entity, whether it's, LLCs don't have stocks, but, whether it's the existing shares or units, or if it's a corporation, the stocks, right? Whatever is consistent of that of equity, right? The equitable ownership of the stakeholders, right? Whatever confines ownership into the entity, you're acquiring that ownership, right? So units, stocks, whatever, right? You're buying it all. But when you're buying it all, you're buying it all. You're buying the assets and the liabilities, right? Everything just transfers over. This is super easy. This is super simple. This is like if you go and buy a car, like you could buy a car like one piece at a time, buy the tires, buy the wheel, buy the chassis, right? Buy the windows, right? Buy each part of that car. And, you can then reassemble it in your driveway, or you could just go buy the title and have it signed over and you own the car, right? Stock deals are easier. They're simpler, right? But there's also a why behind each. And I'm about to get into the why behind each, right? So a stock versus an asset deal. On a stock-based purchase, again, you're buying, the whole ownership of the existing entity, meaning it's a really simple transaction. The seller just signs everything over. And then because they're signing everything over, all of the existing contracts, all of the existing IP, all of the existing everything inside of that entity that's being acquired transfers with the ownership, right? So it's a simple way to get a deal done and transition and integrate a deal, right? However, on the con side, which is really important, this is like the biggest asterisk of this video. If you watch to the end, this is the bonus, right? This is where the value is really actually being delivered. When you are a buyer and you do a stock-based deal, the liability is virtually unlimited because the liability carries with the stock being purchased, right? The liability carries with the entity. It doesn't retain or stay with the owner that's selling it. It follows the entity. So it follows the new ownership. So if you don't know what the liability is, which you should always assume you don't know what you don't know, right? So you should always assume the known unknown in any deal, especially on the buy side, especially if you want to, not, crush yourself in terms of costs on diligence, right? Like if you don't want to have like a ridiculously exorbitant diligence bill and probably double the purchase price, cost the basis of doing a deal, because you don't want to hire like an SME expert to diligence every absolute component of the deal, and you probably still wouldn't know everything in terms of liabilities, right? If you want to just assume that there's liabilities, it's probably the easiest and cheapest place to go. And if you're assuming that there's liabilities, you're going to say, hey, I want to mitigate my risk away from this unlimited unknown sort of liabilities that I'm going to take ownership of. I don't want that. So I just want the assets. So like as a buyer, right, you do not want to carry or take over or assume a potential unlimited risk, right? So we are all about mitigation of risk, specifically so bootstrap or capital, as you know, we're all about mitigation of risk. The investpreneur journey, right? The whole concept of investpreneurship, it's all about mitigation of risk into your entrepreneurial journey or your journey building up assets, right? So because we have this mitigation of risk mindset, right, we do not like doing stock purchases. Now, sellers love stock purchases because they're simple and they're also passing forward all of the liability, right? Because the liability's got to go somewhere, right? So for those reasons, and then also from a tax perspective, right, stock purchases have more benefits associated on the sell side. There are some tax benefits on the buy side, and the fact that like if there's a loss or something of that nature, it can carry forward with the new buyer. But like that does not outweigh the unlimited liability risk, right? But for the sell side, it does, right? And if the sell side is structured in something like a QSBSC, like a C corp, right, and it's qualified for qualified small business stock credit, right, and the seller could potentially avoid like capital gains taxes based off QSBSC rules or any other related thing like that. Asset-based sales potentially could remove that benefit. and the seller could be hit with a larger tax bill. So for that reason, this is typically where deals, come to a crossroads. Luckily for us, with the market that we deal with simple deals, far less complicated than a middle market deal or above, right, where there's more consequences to this decision. Luckily, in the micro equity space, we could typically, there's much less liability in the first place, but b, much less benefit of doing a stock versus asset. So it's easier to get terms that make sense for the seller to then just agree to an asset-based purchase. And typically, always when we do deals, it will most likely always be an asset-based purchase. Also, from an asset-based purchase, you're not dealing with stocks, so you're not dealing with securities. So you're only acquiring assets, which is like a physical good transfer. So it also gets around different types of securities purviews, right? To a certain extent that it does, right? Which again, asterisk disclaimer, not legal or professional advice there, right? Always consult your counsel, right? So for those reasons, we're willing to take and invest the time to negotiate a little bit more of a complex deal up front using asset-based purchases to then remove the unknown, unmitigated, potentially unlimited risk of liability on the backside. So hopefully this video was good. If you enjoyed it, if you got a little bit of insight, if you appreciated the content and the time that went into recording this today, please like and subscribe. We're trying to build up the channel. If you like this content, leave the comments below. Let us know what more you want to know or what questions you have. We're trying to build up this channel to the best of our ability. And I definitely love this topic. I could go into detail on any one of these types of deals, all day long. You don't have to just use one structure. You can use multiple structures, right? There's hundreds of ways in which you can structure a deal. And, the best thing is to just get going, look at things, have conversations. We're all just people at the end of the day. So the deal needs to make sense. If you can look at it from both sides of the table, there's typically a deal to get done, right? I like to say that there's always a deal to get done, but sometimes you deal with irrational people. Irrational people are really difficult to get a deal done with or to do business with in the first place. But typically speaking, even if you acknowledge the fact that they're irrational and you understand where they're coming from, you could still typically get to a deal that makes sense. There's usually always a deal to get done. So for those reasons and definitely more, thank you for watching this video. And until next time.